Hey, greetings. I would say happy Thursday, but markets surely are not. Sorry for the pregnant pause there at the beginning of the video. I am showcasing here the fact that I'm very excited to have Juliette Declercq come in as a guest captain interview as part of my Women in Trading and Finance, but also Macro to Micro Power Hour. It happens to be at 1 o'clock East Coast time because she's in France. So there's obviously a big time difference, and wanted to make sure to have this this opportunity to talk about women in trading and finance at the same time as reviewing her calls right now, especially as it relates to the Fed Jay Powell speech earlier at noon, wherein the market is definitely reacting. I want to just make sure she's got the link and everything's okay, but right now I don't see her yet. So as soon as I do, I definitely will make her live panelist, and we can have a discussion about women in trading and finance. Also, this interpretation of not just Powell's comments, but also the market's reaction. So let's see if I can grab her, and she's likely having an issue with the panelist link. Sorry about that. Maybe there's other interruptions, such as market drama. I know it is. Yeah, and I have some questions that my clients have given in anticipation of this talk. So waiting right now to see if you have any other questions, definitely hit me up in chat here so that I can ask them of her when she comes in. There she is. Hold on just a second. Sorry for this little delay. Copy invite link. A little time frame difference. Oh, she's coming in. So sorry. She has it at 1 hour, a little bit different. No worries. We'll get you in here. All right. I'm holding the room until Juliette can join. We are definitely in some whipsaw action here. Let's see how market deals with this yield spike that we have right now. Not a surprise. We also have a SPY breaking a channel, and the Q's right down on support, which happens to be my short price target of 303.50. So let's see if we get some stabilization in here. In the meantime, let me just pull her into panelist mode. Poor thing. She thought it was 1 hour later. So glad she checked her DM. There she is. Yay. Hold on. I'm coming. There she is. All right. I'm so glad to see you. Hi.
All right, Juliette Declercq has joined us from, are you in France?
I was in France. That's why I got the time wrong. I thought the meeting was in 1 hour, but it's fine. I have time to put on some lipstick, but I'm sure you will be okay with that.
I'm totally fine with that. All right, so we're very pleased to be joined by Juliette Declercq. I mentioned several times that this is an honor for me because, and I'm going to stop sharing, and this is her site, by the way. I have basically been admiring her work from afar for years. You were first on Real Vision, and I think it was, how long have you had JDI research?
I think it's the 6th year. So okay. I started in 2015.
All right. When you were on Real Vision, I remember it was an hour-long special, and you were the only woman on this particular hour-long special, and your charts were bar none the best. And I was so excited about it. I reached out to Raul, said, oh my God, you have to have her on again. She should be front and center. Her stuff is just brilliant. And you were actually, I think, I don't want to say used and abused, but you were on there a lot. It probably cut into your business time a lot because you were doing a lot of analysis for Real Vision in the early years. So you're on macro voices and the like. So I've been following your work for a while. And when I did this idea of macro to micro power hour, which is obviously, you know, kind of operationalizing what's going on in the backdrop to trades, and you do this research, which is very much the same thing, but at a higher level and longer duration time frame, I'm sure, than what I'm doing in my live trading room, and with mostly retail clients and some small institutions and, you know, the like. It's, for me, really exciting to have you on as also Women in Trading and Finance series, because you are one of the few macro mavens out there with such a good, keen, research protocol, but also some really great timing calls. So thank you so much. We moved this to 1 o'clock from 4 o'clock to kind of accommodate that time zone difference. And then of course we have Powell coming in and causing all kinds of trouble here to market volatility.
Powell and I wasn't thinking that I should have been more careful about the time difference and the jet lag between France and UK. I only just came back yesterday to UK. So,
Well, it doesn't matter. So have you had a chance to take a look at his comments and interpret yet, since they are literally fresh as of?
It's exactly what I expected. I think there isn't much, nowhere close to enough tightening in financial conditions to really make Powell backtrack here. But I think it's a bit of a mistake, actually. I'm not sure if we're supposed to talk about markets now or.
We're gonna weave and dodge. I think we absolutely should, because it's so timely, obviously, with the rate volatility that has clearly seeped into equity volatility. And I'm, just looking ahead to see what markets are doing and where they're stabilizing. But I think it's fair to say folks want to get your insights also on these moves.
My recommendation to clients today and for the whole week, really, and that's a big change from what I've been recommending for the last pretty much 11 months now, is to start buying dollar dips, to sell Nasdaq on spikes, to continue the complete rotation away from growth and bond-like sectors to much more cyclical. And my main recommendation here is Europe, so SX5E, which is much less sensitive to steeper curves and higher yields as a result. In fact, it's probably an index that will benefit from steeper curve and high yields as a result.
That's actually one of the clients' question was, how will Europe manage to agree to any further EU level stimulus if required when last time was tough? And if not, how will worst off countries manage to cover? So just in relation to the recommendation there on Europe indices, what about that particular focus from a client just asked?
Yeah, so I just want to take a step back, because I think we are at a really interesting juncture in markets, potentially like an inflection in the reflation trades that have been going on now for like 11 months. And that's probably the longest I've held recommendations ever, like at JDI Research. And I think there's two really interesting things happening, which I think we should be talking about, because it's just such a timely interview that I don't.
Yes, macro-driven market right now.
Exactly. So what's going on is like on one side, you've got China really pushing the brake now after being one of the main engine of like reflation. And that's one thing. But the second thing, which is, I think, really important, is that the steepening and much higher term premium on the US curve have started to leak into the front end of the curve. And the reason for that is something that we haven't really seen before, is basically the Fed is so vague on its reaction function. And, of course, we know it's going to take a substantial amount of macro improvement, and there will still be some time after we've seen that macro improvement before the Fed even thinks about hiking rates. But this is nowhere close to what we had before, which was basically clear calendar-based guidance, and the problem is like the reaction function is blurred enough that it's actually allowing markets to start pricing much higher term premium at the front end as well. And the issue with that is that other central banks, like if you're looking at the ECB, if you're looking at the RBA, so the Bank of Australia, they're very much pushing back against market pricing on that sort of bump, and allowing markets and disallowing markets from like extrapolating that bump in macro improvement at the front end. The issue you have if markets really start to front run markets is that you actually could short circuit the recovery. And the problem is it's really what the Fed is doing. And the fact that there's a differential between what the Fed is doing and other central banks really pushing back against front end moving, like the Central Bank of Australia has actually doubled its QE this week. And the ECB has been quite clear that they don't want to see markets front run the recovery. That's basically the reason why the dollar is starting to strengthen again. Mm-hmm. And I think if on one side you've got a reflationary break from China and a dollar that's really starting to strengthen again, in my opinion, that can really lead to much tighter financial conditions in, certainly ahead of the Fed. So I'm actually looking for right now a counter trend in the reflation trend. Which for the first time in 11 months, I actually see as totally tradable. So yeah, I just wanted to have a word on that, because I think it's extremely interesting times.
Yeah.
And the timing.
We're aligned on that. I mean, there was a historic 8.8 standard deviation move in that factor rotation from growth to value back in June of last year. And it was very much a spike that was sold. And then, into the summer, later summer, and then into the Biden bid election, and, the vaccine and the blue wave and all of that, it has just increased in support. And I've been on that for 7 months. So you're longer than I have been, but very strongly on yield, inflation and commodities and cyclicals and the rest. And then last week, in fact, in my Tuesday session that I do with Jonathan Gibbons of VigTech.io, we always pick a macro theme. So last week it was a dollar, before that rates, before that volatility. And they have been really very, very helpful, I think, for clients, but also in fleshing out, if you will, what I'm seeing live in front of the screens all the time, which is we're going to spike higher in yields and maybe have a little softness come in today. That's obviously, further supported. But I saw oil turning last week, had a nice 7% pullback. And now today, obviously, it's hot fire flames. At what point does oil become a headwind, not a tailwind for this thesis, and actually can do some damage?
I mean, totally. That's exactly what I was looking at today, and I think it's the exact right time to start talking about this. If you actually look at inflation, and like you can basically look at prices paid on ISM, and you basically do a lag of like about like 15 months between prices and activity. There is a very stable relationship between basically inverse relationship between prices and activity. In other words, there is a point where higher prices, and obviously oil is entirely part of that, starts to basically short circuit the recovery and become self-limiting.
Yep.
In terms of basically curbing final demand.
So do you have a number in mind for that? Because I do.
A number of what? In terms of what?
Like in crude, a price where it starts to become problematic.
No, I don't have a number in mind. I basically use it in my models as like one of the inflation, headline inflation, basically. And it's more in terms of like, year-on-year move that it really matters.
Do you feel that this steepening yield curve will continue? Obviously today it sure looks like it, but or are you expecting maybe the next Fed meeting, some iteration of yield curve control? I mean, obviously Australia did something on Sunday night to kind of slow it down, and China's been meeting about it for the next 2 days, talking about deleveraging, but it's talk for right now in China. What do you think in regards to the 10-year? Where do you see it this year going? In other words, at its high. Do you think it's going to go back to 2% pre-COVID?
I mean, my initial target for the year was 1.5. We've been there. We've got there like much faster than I thought. On the back of much higher term premiere. I was looking for like basically 50 base point move in term premiere in the first 6 months of the year, and we've basically done it in like a month and a half.
And I
so normally
Twitter.
that probably means that we keep going.
Oh, can you hear me?
Okay. So I think we can still move higher. I mean, we've basically, in terms of like term premiere, because of the like real macro revolution that's happened over COVID, I think we're still not discounting term premiere that are actually taking into account the complete sea change into the inflationary environment. So in other words, I'm not talking so much about the risk of inflation. I'm talking about inflation actually happening, but I'm talking about like much higher risk and a much different skew than what we had pre-crisis, where basically term premiere were like minus 90 basis points. We've only just come back to positive on that. So I think there is definitely more upside into yields. And the way I like to trade it and to recommend it at the moment is basically via short bunds, which I think are a very good expression of higher term premiere.
Short what?
German 10 years.
Thank you. Okay, so bunds. So the curiosity I have is because we were obviously at 2% pre-COVID, and we're at 1.5 now. 1.5 is a lot, relatively speaking, with especially the 5-year is extremely strong, but it's the fastest rate of change in the 10-year ever. In other words, the time compression of launching is literally the fastest, much faster than 2012 as far as this explosion. So that very means of front running, if you will, is the worry. In other words, is it overdone, or are they just really seeing it and they're just off to the races because it's going there anyway, like the Fed wants it to go there? What's leading, the market or the Fed?
I mean, clearly markets are leading there, which is obviously an issue in terms of like economic potential. What really was the hallmark of this recovery is that markets were prevented from front running the recovery. And that's really what happened in 2020. Unfortunately, in 2021, it's no longer the case. And I think the stimulus, like, we were first talking about 1 trillion, then we are talking about 1.9, and then potentially like another 3 trillion after that. And I think it's really like talking about, is there too much of a good thing? And I think we are really at the point where, for markets, it is really too much of a good thing. And I think we should probably eventually get back higher than pre-COVID crisis in terms of 10-year yields, if it was just for the reason that I've just discussed, not the fact necessarily that inflation will go much stronger, but the fact that risk around the base case scenario are much, much higher now that you've got a policy mix which is basically standing on 2 legs, not just monetary but fiscal as well. And I think populism is so strong, and the willpower, the people's willingness to really get more and more money printing is so strong that it will be very difficult politically to exit this policy. And that probably means that we should be having like much higher term premia and in turn higher long end. Now, I don't think the long end being much higher is a big problem. I think it really presses the rotation out of seemingly like sort of like tech bubbles that are basically priced like bonds, and basically forcing the recovery into of more cyclical stocks, which I think is a good thing. It doesn't mean that we're seeing a crash anytime soon. What it means is that we are heading towards more stability. What Powell doesn't want is basically to create a bubble in the next 3 months and then having to burst it when you start to have to like basically push on the brake because of higher inflation. So I think the Fed is probably like sort of caught here, because higher term premia is good for long-term financial stability. And what you don't want is to have like a shock of real yields as soon as you're starting to talk about like normalizing and the sort of like taper tantrum that we had in 2013. So it's all about really smoothing the path towards like normalization. And for sure, that means higher real yields, higher term premia, and a very strong rotation away from bond-like equities towards cyclical small cap, and this is just really only just started.
So and it's also a good place for it to pause in many respects and then kind of digest before moving higher. But right now, today, obviously, we're not getting. We're going to get that. But for right now, the other big question on my mind is on this, the ISM, for example, all 18 industries reported excessive issues with supply chain, higher, material costs, shipping constrictions, supply inelasticity of lumber. I mean, you just can't manufacture a tree. There are a lot of costs that are going up on the supply side, and the demand is still there. How do you think that's going to work into, and it's also been driving a lot of, inflation expectations with higher oil and yields, commodities and yields, they pull each other up, but in particular supply chain. What's your view on that area, since it does seem to be a very weak link from chips to you name it, lumber and the costs thereof? What's next in that regard, especially as it relates to inflation?
So I think in 2021, we have like such large pent-up demand and probably such a huge desire to like get back to normal, that the pricing power to basically swallow those increased costs and supply driven inflation is probably not going to be a major issue. I'm more worried about 2022, where especially because inflation has a very long lag of up to 18 months. So you might end up in 2022 with like a growth sort of like normalizing, and inflation still feeding through the pipeline, which will sort of like end up into like a mini bout of like stagflation.
So how about and its effect on annualized growth? Do you put targets on that for this year, for the following? I would think that would obviously, cut those growth projections in 2022. What's your feel on that?
I mean, I don't actually make forecast. I really like what I do is like call markets, and I leave the forecast. I leave getting the forecast wrong to economists.
Oh no, I'm not looking for particular levels. I'm just talking about in general. This is a strong rebound from last year, and then it mitigates in 2022. Is it similar idea as far as growth is?
Yeah, that's exactly what you're saying, and that's exactly the problem with the Fed. It's just basically letting markets extrapolate this growth that we're going to have in 2021, which is obviously massively artificial, extrapolate that into 2022, because markets are not as good at fine-tuning forecast and like growth forecast, which may, in the end, basically short circuit the recovery and turn reflation trends into, stagflation, because inflation is a lagging indicator.
And a question for you, Juliette, is how do you feel about emerging markets and commodity-linked stocks, in iron ore, pulp and paper, et cetera? Is this higher risk, lower risk going?
For me, emerging markets, and that's been like my favorite trade since June last year. In terms of, for me, it's like those are trades that are like completely driven by liquidity. And I wrote an email to clients last week that I felt the liquidity ship has sailed really. And I think the burst, the flood of liquidity that we've seen over the COVID crisis has now, at best, we're going to stay where we are, but we're not getting any better. Which make me think that you have to get out of liquidity-driven assets. Obviously, emerging markets is a major one, but I've been also worried about metals. I mean, copper, for example, is like directly linked to the property market and constructions in China, and a direct symptom of like excess liquidity in China. So I'm a bit worried on that as well, because obviously like China is the one place where authorities are starting to be especially more worried about bubbles, and especially property bubbles. In China, it's all about property.
I saw a great chart that I retweeted that has that China impulse in the commodity trade actually rounding and coming back over, while our inflation expectations are ridiculously off the chart, still parabolic. So a catch up or a catch down trade there. So this is a pause, in your estimation, not a trend reversal. So this inflation is going to be sticky. But you also think the consumer can handle the price increases from all the, the supply chain woes. But 2022, you have some other concerns around growth and stagflation, but not so much the second half of 2021. You think we're gonna ride it out? Just
I mean, the way I'm thinking right now is that we have a counter trend in which is currently happening and has legs. I think that will end up into basically the Fed having to anchor the front end of the curve. Whether it's with calendar-based guidance, like basically saying we're not hiking before 2023 or 2024, or whether the Fed has to go all the way like YCC, which I don't think is necessary at the moment, and that would be probably like a bit more of a drastic move, which has its own problem as well, because with YCC in a deflationary environment, you actually buy less bonds because it's really easy to anchor yields at like 10 basis points in a deflationary environment. So that means liquidity is actually lower in a deflationary environment. So I don't think YCC is like the magic answer to everything, but certainly a bit more clarity on the Fed's reaction function to anchor the front end is what will be required in the next few weeks, whether it happens at the next FOMC, if there is enough of a market route, or whether it happens further away down the line. Then I'll be looking for another wave of reflation. Obviously, economic reopening. We see what happens with pent-up demand, excess savings. What happens, obviously, to money velocity as well. For me, it's just like the most uncertain macroeconomic environment that I've seen, in the past 2 decades, because it's all linked to human behavior, animal spirits, and I think, you could basically like turn one way or the other. Are we going to see like the roaring 20s, or are we going to like struggle to get back to full employment and basically get like pent-up demand spent in a few months before we actually get back to disinflationary trends? So I think that's really what makes this year really fascinating. And to be honest, like the last 6 years have been fascinating. It's difficult to think of a year where you really struggle to talk about interesting themes. But I'm really excited about this year.
Go ahead.
And I'm actually particularly excited about like this environment right now, where you can see that we are moving to a different macro cycle, different macro narrative, and basically markets are ready to be reinvented, and like with different trends. And obviously,
yes, like the SPACs, right? The special purpose acquisition company corporations with the blank check approach, where speaking of liquidity, it's today there's a real SPAC attack of red, meaning that supply is just it's drowning by the weight of it, if you will, but it's still a new asset class. Last year it was Bitcoin was the new asset class as it related to institutional sponsorship. So it is inventive, right? I love how it's non-fungible tokens is the new buzzword. I mean, it takes on its reinvention. It definitely reinvents all the time. But the value trade and the cyclical rotation, we have definitely come up into some areas of concern, meaning with higher yields and higher oil, and now what looks like a turn, a solid basing of the dollar for a few months now, and moving higher. What's going to wreck it? Any of those three, getting too high and mighty is going to slow things down, both in equities and the economy. So I hear you. I've expressed it kind of like an air pocket of risk to the upside and the downside. And we're sitting in between right now, and we could go either way. And I don't just mean the froth coming out of the tech plays, those bond proxies that have definitely been softening the past few weeks. And now, like everything else, which is intensely shorter in time frame, they are selling off quickly, like decisively. And now the question is, will the dip get bought as we watch oil and yields and dollar rise? It doesn't feel it anymore. It feels broken. You're not worried?
I'm not buying it. Thank
you very much. So thank you very much. Are you buying the dip? This is because we've lost all gains for the year now, as of today. Powell did not say anything to appease, the market gods, if you will. They're a little angry.
I'm only buying the dip in European stocks, which are still extremely cheaply valued and which will benefit from higher yields. Basically, what's interesting as well in Europe is you've got a very different feedback loop from higher yields to the economy. Since the advent of negative interest rates by the ECB in, I think it was 20 2015. What's really happened is the more they cut rates and the more people were saving. In other words, because you get nothing on no return on your savings, you had to basically save more towards retirement. So when we get back to higher yields in Europe, it's actually releasing savings into the economy, and obviously because the aggregate index as a whole is much more heavily like finance, like banks, insurers, and also industrials, you actually benefit as a whole. So higher yields do not tighten financial conditions as much as what happens in the US. So
how do you manifest that trade? What are your favorite vehicles? You're getting asked in chat.
So European stocks, like the whole index, basically, SX5E on Bloomberg. And that's the one recommendation that I still have on. But I've got out of emerging market FX, and the dollar short as a whole last week.
Okay. So the dollar short as a whole, but not long.
Not long yet, because I think it's a counter trend, and I like to focus on clients can basically trade the counter trend, and I'll be looking at it and but I try to focus on the really underlying trends. So I will only get I'm basically currently tactically neutral on the dollar and looking to eventually re-enter shorts.
Okay, so just to hit a few questions, and then I definitely want to get totally pivot and talk about how you got into this space. And your experience, obviously, and any stories you want to share as a woman in this space. But I definitely want to make sure that Thomas gets he had 3 questions. Did you see them? I put them in DM for you, and they are a little bit lengthy, so I don't want to read them out loud, but maybe you'll have a chance to take a look. There has to do with the stimulus both here and in Europe. Did you get a chance to take a look at that? If it's too lengthy a response, you can hit me via email, and he's a client, so I can definitely send it back to you.
I'll respond to you. And sorry, I did read it, but I just thought it was a bit technical to
It is a bit technical, which is why I sent it to you directly. Okay, you're going to get your own personal response, Thomas. We're not going to do it right here. Oh, and definitely, you had already kind of alluded to this, but what should the Fed be doing right now to calm markets? What do you think would be their best approach?
What the Fed should be doing really is try to anchor the front end, make sure that the curves keep steepening, and be a lot clearer as to what and when, what they'll be waiting for to basically start tightening financial conditions, and probably go to like calendar-based guidance rather than the sort of like blurred reaction function, which we currently have.
And yield curve control whisper would just make the market freak out, likely, in their concerns about illiquidity.
I
don't like that solution. It's a nuclear one potentially, but it's not really the safety play. At least in the short term, it would be introducing a lot of volatility.
Exactly, and I think you can really, especially for the Fed, I think you could really shoot yourself in the foot by doing yield curve control, because that would really mean that you inject less liquidity in a deflationary environment, which would be in Japan might not be much of an issue, but when you've got like the main reserve currency, that would be an issue.
What's going on with Japan right now, by the way? Have you any comments on that? They had some moves the past week where they've no, I haven't
not really. The same as like everywhere else in the world, basically like 10 premier moving up. That's not a US move only. It's really like a global move, which is finally reflecting basically the macro paradigm shift that we've had last year.
Oh, it has
which
been a regime shift, no question.
Exactly. And I think, we've basically repriced first growth like equities, then we went to cyclicals, the dollar starting falling. And finally, the last piece of the puzzle is really to basically reprice yield curve. So it's really a continuation of exactly the same theme, which started, in April, end of March last year.
March 23rd, Intervention Day. All right.
Exactly. At the end of March, I wrote a report called Casa de Papel, which basically explained that, we were just going to print the money. And I don't know if you've seen the series on Netflix, but basically that was just, the idea is just like, we're just going to print out of our concerns and it will not stop because people are calling for it, are clamoring for it.
And they're accepting it, which is even more shocking.
Exactly.
Now it's not just a regime change. It's an acceptance. It's now not. Yeah. Anyway, I don't want to run out of time to get your stories and find out how you got to this place, because your research-driven approach, but also market timing, is tight. It's rigorous. It's very timely and prescient. It's outstanding, much better than I don't even garden variety economist, but most macro wonks. And you're under the radar, in my opinion, as it relates to, gravitas. It's a shame, because your voice really should resonate louder. And I have to wonder, is it because she's a woman? What's up with that? You have such a powerful brain, your insights, your analysis. I just think you should be everywhere. So this is my personal, praise, but at the same time, you gotta have an opinion of this space. What is it?
So, I don't think the fact that you don't hear my voice as much as many means anything in terms of like, I get a lot of requests to, talk on social media and etc. But I've got a service that is, very pricey. I'm definitely at the top end of what clients are keen to want to spend on, and basically my clients just don't want to see me on social media. So I have to be like really, I have to be very scarce in terms of like, interviews I'm going to give, what I'm saying on Twitter, and etc. I'm sure if I was talking every day on Twitter about what I think about the markets, I would have like by now like probably 100,000 followers, but that will not pay me. That will not send my kids to school, and that won't pay the bills. So I have to really cater for clients that are basically paying me, and that are basically getting a JDI subscription and want to get the information for themselves. I also think that once you're on social media telling everyone what you think all day long, basically you completely lose your value added. I'm a very strong believer that if you start sending out information to like 100,000, basically by the time you press send on the email, it's probably lost like 3/4 of its value. So I'm really trying to focus on having as low a readership as possible, and really on the value that I can add to clients with like different narrative, different ideas, and different ways to look at markets.
So exclusive obviously pays, and you're not paid an ego by being a social media maven. You are actually paid by your research and analysis. How does this translate from where you came from? Like, how did you get here? A little backstory on how you got to open your own shop.
Interestingly, I did get here because I'm a woman. I spent, so I started in banking, and I was always like talking to traders. I was an investor myself for 4 years. I started in banking in 99, I believe. And during my all 20s, I was basically told our women were amazing. And I was like invited to like woman empowerment meetings every week. And that was in my 20s. But everything changes when you're a woman and you're starting to talk or like having children. So I was the best thing in town until I basically got pregnant. And then interestingly, everything I used to do became a bit of a problem. And I felt very much pushed out. So much pushed out that it ended up in like in a legal case, which I won, which gave me the financial independence to have my child and my children first, and then think about what I really wanted to do. I think that's the first hurdle you find as a woman is, for me, it was never any different until I had children. Then when you have children, I think there's always an assumption that you're going to have a second one, that you're becoming a cost center, really, just because of the fact that you might get maternity leave. And then you come back from maternity leave, and your self-confidence is actually quite low, and most will probably make you pay for it, make you pay for those like 2 years of what they probably still consider holiday, even if I can assure you that it wasn't a holiday for me at all. So basically you come back to the market and you take a massive pay cut, just for the fact that you're a woman and you're the one bearing children. So I didn't want to take take that pay cut, and I just thought, what, if I'm going to do it, I might as well do it for myself. And instead of taking the pay cut, and instead of being like sort of like demeaned into like doing into basically redoing my whole career, restarting my whole career from like a much lower level than where I actually ended it, which, and I know I'm not the only case there. I mean, I think, most women take a massive hit, salary and promotion wise, over, just taking, 2 years for having children. And that's the same whether you're taking the years or not. So I decided to start my own business instead. And, I worked really hard. My process is very different than anybody else process, because basically I am a trader. I am an investor talking to traders and investors. But I don't trade because it's not my passion, and it's not really what I want to do. And so I think that makes my profile very different than anyone else in this business, in the fact that I'm not that interested in money. I'm interested in actually getting the macro calls right.
Oh, and you and I are aligned in this so much. I love to trade. I love to analyze, and I much rather be right than fear of missing out. I can add so much more value, in my opinion, because that is just highly tuned, and I can cover everything, even though I don't have the pedigree. You grew up in the shops, but I did not, and I in other words, trained in that model. Restriction's not my jam. I can study anything I want. I love having my own business, but in this space. But to your comments of the child component, I mean, you see my 3 in the background. They're all in college now, but it was very clear to me, corporate America or what have you, it values production, not reproduction, and it was an incredible hit. In every single regard, financially, emotionally, physically, oh my God, and working by candlelight for so many years. And oh my God, the talents, the skills of managing so much, household and children, and primarily in my particular case, it definitely fuels this need, I think, for self-reliance and reinvention. So this, for me, I've got lots of time now that I didn't have before, because they're gone, right? So I was underutilized, and that's really when I had the confidence to go out and fill that big honking void, honestly. So now I feed it with work, and I work a lot, but I love it. And I have the same passion as when I was raising my family for this business. And I just love the learning aspects of it. But yeah, to your point, you went off and did your own thing. And this has made a world of, sorry, my alerts are going off here and they're kind of loud, but don't want to turn the volume down either so I can hear you. So now this is your quality of life, your kids, Europe, and I see you skiing. It looks fabulous. Sorry about that. I should probably turn that bloody thing off, but we are in market mode here. We're in the middle of the market day too, so I'm a little leery. Oh yeah, we definitely have some drama here on the market side. Okay, so we luckily very short biased. In fact, all of my trades for clients in the past 2 weeks have been short, with few exceptions. So this is anticipated. Let's put it that way. But in regards to, what's going to give here to make your voice, maybe not market timing calls more prominent, but women need to see what they can be. And you are a top market caller, right? And macro analyst. What do you hope to see in this space? The Real Vision has a platform and Macro Voices has a platform, but predominantly it's male. Any suggestions there? What we can do more of, less of, to make this a little bit more of a level playing field, because it's not. Did I lose you? Oh, perfect timing.
Men have,
There you are. Okay.
I think men have a much bigger ego than women. And personally, I'm just not into having 100,000 followers. I'm into basically making a massive difference for my clients. So I go on Macro Voices because there's a huge amount of very clever potential clients on there. So and that's really the reason I do it, is basically to feed a pipeline of people that I can actually help achieve their help in their investment process, help as a CIO, help achieve their macro dream of understanding what's happening. But I don't really get the whole being on Twitter all day long. I don't get it. For me, as life is just too short. I've got 2 small kids, that are 6-year-old and 9-year-old, and I want to focus on making a difference for my clients, giving time to my kids, and also have a lot of time for myself. I've got lots of passions. My first passion is a passion for life, really. This year, as you talking, I've discovered ski touring in France, and I've been doing basically 3 times 3 hours of going up the mountain on my own in nature.
Beautiful.
And I'll just rather do that than taping an interview.
That's good balance,
So
but it also clears your head to go back there and look fresh at all the across asset classes. So you're doing both, living the dream and also really adding a lot of value. Well, it's wonderful to have an opportunity to find out also any stories that you have that are kind of funny or not, but definitely from the travels of navigating both in financial services. Predominantly, clients are men, And the analysts are men for now, and we retweet kind of the same thing of trying to level up the playing field in regards to women, the voice of women, and definitely compensation for women in financial services. It's going to change, maybe slowly and then all at once. But are there any stories that you have had, that really shaped your let's just say voice?
In what way? In what way do you mean? I mean, for sure, I think being a woman in the financial industry has definitely shaped my voice in terms of aggressiveness. I certainly have become a lot more aggressive than I was in my early 20s. And I became much more assertive, which some will be, thinking is because I'm French, but I think it's much more about. I think it's much more about being the one woman on the trading floor. Being, that I was for like 3 years the only prop trader for JP Morgan, like the only female prop trader. So I think really, I mean, if anything, I've learned a lot. Probably that's the reason why I'm not a trader today, because it just doesn't make me a really good person. It doesn't make me a person that I really want to be. Even more aggressive than in trade would call me, and it would be in the middle of payroll, and it's just like I couldn't think about anything else, or like being waking up in the middle of every single waking up morning, really, and living a full life. Maybe that would be more. Maybe that's just more compatible for like a male who take less of less time on average. With children, for example.
Oh, I love that. Well, and I didn't, we had a little bit of video disturbance, jet lag aside. I think we have connectivity issues, but a little bit of that was lost. But long story short, you really have grown. Your voice has definitely made an impact for me. Let me put it that way. When I saw you on Real Vision, I went, oh my God, I have to follow her and see where she goes. But also the quality of your calls I've been tracking them, and they're excellent. So I love the voice that you have. Keep it up, and your balance with family, life priorities. I think that's super, super example. And I want, again, more women to see what they can be, and you're doing a really good job. So I wanted to just personally meet you. Obviously a big fan, and appreciate the time to also give market calls, especially on this kind of momentous, not even a Fed day. Powell hits the podium and the markets puke. So thanks for helping to translate them.
Yeah, I mean, I like to add value on interviews when I know there is value at the moment. So, you've got a great market, great interview timing. So I thought I'd make the best of it.
Oh, thank you so much. Well, enjoy your evening, and I appreciate those who came. And for a little housekeeping, where this is going to show up on my Declercq trading website and also YouTube channel. So here is the LeducTrading.com, but it's going to be on Declercq Trading channel, if you can hear me, under macro to micro power hour. No, under women in finance, trading and finance. So right down here. So definitely look for it. I will upload it later today. And thank you so much, Juliette. I appreciate your time and your calls. And I wish everyone a great, safe rest of the week in this market volatility. Take care.
Thank you very much for your invitation.
Thank you again. Bye.